morning, everyone. BD from Bluestone Flagship. As you guys always know, investing is one of my favorite topics to talk about. And this morning, Avi came in and is like, hey, do you have a presentation for us today? Wanted to have one about asset protection, but since I'm not a lawyer and I don't want to be talking about asset protection, I wanted to share with you a little bit more about a different type of concept, mainly about building and stacking passive income. If we can go next slide. This is just what our lawyer asks us to always show, that this is not an investment advice. Do it at your own risk. We're not tax advisor, et cetera, et cetera. Next slide. Our topic is about passive income investing. And what that effectively is all of us like to invest and receive passive income. And over time, we build up enough passive income, basically mailbox money that comes in. Now we can retire or choose to become job optional. That's really kind of big picture. But today we're taking it to the next level. We can go next way. So some food for thought was like, how do typically people retire? They work, save a lot of money in their retirement accounts or whatever they are. And when they get to about $1.5 million, they're like, okay, and now I'm going to go financial advisor. They're going to help me pull money out at 4% per year. And that's going to get me, my, $5,000 a month to live on in my retirement, and all happy and dandy. Not yet. Sorry, not yet. But effectively, how to get to the 1.5 million, or are there different ways? Again, you name it, based on the type of investments. You could work with your financial advisor, you could invest in the stock market, but really just saving up money to get to that 1.5 million is not gonna work. So you know that even if you're putting down $2,000 a month, it's gonna take you how many years to get to 1.5 million? 750 months, which is about 62 and a half years. So if you start about age 3, you would have a chance to retire at 65. That being said, we all know that we gotta invest, and again, that's why we're here to talk about the next topic. Next page, please. All right, so when you're cooking anything, you're always gonna look at the ingredients. So to do this passive income stacking, what are the ingredients that you need? What are the key recipes of things? And this might sound a little bit off, or not off, like maybe you're not familiar with all these things, but let's just say that you need some ingredients. You need to have leverage, and leverage is effectively the ability to be able to pull money at a low rate. You need to be able to generate cash flow. Have things like credit lines and amortized notes. What amortized notes is when you become the bank and you're lending people in a more formalized manner. For example, you lend them $10,000, they're paying you over 36 months, you end up with about $360 a month coming in. That's really kind of the concept here that we're going to be building on. Next slide. So these are the ingredients. So effectively, we want to be able in a position to calculate, hey, this is our current home take. Here's one of my expenses, and every month I need to be able to free up $2,000 a month. And that $2,000 a month, I'm going to be investing in this stacking strategy. And what I'm doing with a lot of this stacking strategy is what I'm going to be explaining next. Let's go to the next step. I'm not sure what that is, but I'll walk you through, I'm not sure about the circle. But effectively, we're trying to start with $10,000 of leverage. So we have a business with a credit line. We can pull $10,000 of credit. Could be a 0 rate, could be a 5% rate, but the whole point is we want to borrow some money, or if we have some money, it's great. We want to borrow that money at very, very low rate. And then we're going to find a note. A note is effectively a loan that we're giving out for somebody for $10,000. And then we have basically an agreement. They're going to pay us 36 payments, each payment every month. And that would generate for us, actually, can we go, Avis, to the next slide, just to see next slide for a second? Okay, we'll go back for a second. We'll go back. Yeah. A little bit more down, if we can. So once we create that note, they're paying us every month $360,000. We're going to take that $360,000 and pay back the loan that we borrowed from. Remember, we borrowed $10,000 from the credit line, and then as well we said, hey, every month we're taking that $2,000 from our income and we're paying down that loan. So now we borrow $10,000, we lend it out for somebody. Every month they're sending us a check for $360, dollars, and then we're also contributing down to pay down our loan that we took, that credit line for $10,000. So effectively, it takes us actually about 4 months to pay off that credit line that we took for $10,000. Yet we still have about 33 payments of $360 coming in. So what we do at the end of 4 months is we pull another $10,000 from their credit line and we issue another note to somebody else. Another note for $10,000 for 36 months where they're going to be paying us $360 a month. But at the same time, we're paying down that note. Now, between the two income of the two notes that we have active and the $2,000 that we're injecting to pay down our note, we're actually paying back the $10,000 that we borrowed in 3.5 months. So now, as you can see, it starts to accelerate. Guess what? 3.5 months later, we're going to pull another $10,000, put it in a third note. So what we're doing is we're stacking notes. We're making basically, we're lending out 10,000, we're lending out another 10,000, we're lending out another 10,000, and now there's all these streams of them paying us notes. At some point, you start pulling 10,000, and within 2 months, your note is fully paid. Because you're really, so here, if we go up a little bit more, sorry, you know, when you have 3 stacks, it's not showing here, effectively in 3.3 months, your note could be paid. So you see how it's actually accelerating? Because you have 2 streams. You're still contributing 2,000 to pay down your borrowed credit, but at the same time, you have 3 or 4 notes coming in to also pay that for you. Now, we go to the next step. Now, instead of pulling out 10,000 from your line of credit, we're going to pull 15,000. Why can we do that? Because now, as we lend out that 15,000 and continue to contribute into the paying down the loan that we have, we can actually pay it down a lot faster. So now it's going to take us 3.5 months because we have all these payments coming into us. You know, every loan that we did, 330, 330, 330, right? And the last loan that we did for 15,000 is even paying us more. So it takes about 3.9 months to fully pay that. So we just keep creating more and more. We're borrowing, creating more notes, more income streams, paying down the debt. So at some point, you keep going up, next slide. When you get to about 7 stacks, now you're paying it in 3.1 months. Because you're constantly paying down that 2,000, and you're constantly lending out, and you're getting all the income stream and paying down your credit. And that's all. We're just basically sitting between 2 transactions. One transaction is borrowing, one transaction is lending. Now, you're going to question, well, how do you know these are good loans and all that kind of stuff? But the whole point is, I'm just showing you the math behind the process of what you can borrow, what you can lend out. Mortgage guy's happy there, he's nodding. And then how quickly you can actually pay your loan. So if we keep going one more time. So if you run the math based on this theory, after, you're going to get about 4,772 in about 36 months. So that's your $5,000 of passive income right there. And it does not take a whole lot of time to do it. Part of the reason you're able to accelerate it is because you did a topic called leverage. Leverage is what banks do. When Bank of America borrows money from the Federal Reserves at 4.5%, they lend that out 10 times. And that's kind of what we're doing at a private scale. We're not a Bank of America. And the feds won't give us the ability to lend out our money 10 times. If we did, we would all be retired in a few months. But that's really kind of the concept. You're doing it at a level where you can get money at a really low cost and get the returns from that money and pay down that debt. And then once you pay down that, the credit line you took, redo it again, redo the process again, over and over and over. So again, you really leverage what we call OPM, other people's money, people paying you. People need that $10,000 to buy a car, right? And you're financing it for them for 36 months. But you're getting that continuous stream of income. So at the end of the day, what happened is you can really generate passive income stream. After 10 years, you're talking about $34,000 of passive income a month. And your stack size is about 170,000. So because you're really losing about 1.8 million of other people's money. And that's just one method. I enjoy investing in debt. And we're not promoting anything that we're doing here. We're just showing you a strategy of what you can do as you invest in debt. It's just one mechanism to help you build passive income. Go to next slide. I think that's it. Question?
Yeah. formula, the vacancy, meaning the potential of people not to pay you on time.
So what you're saying is like, what if the payments coming at you
10% of the people that need to pay you will not.
default?
Yeah.
You can actually model that in, and in fact, it's just going to take you a little bit longer to pay it out. You can factor whatever, but again, at the end of the day, what is it that you're lending against? If you're lending against somebody buying a car, and you're giving them a loan for $10,000 to buy a car, and they need a car, and you validated their income, again, your question is like, how do I validate that the notes that I'm creating are valid? Believe it or not, there are companies that are in the business of creating notes. You just buy the notes. So they do all the underwriting. They do all the criteria to take these notes. And you just come in as an investor, you step in, you say, yeah, I want to buy that note.
So 2 questions. One of them, what's the cost of doing business, right? The notes. And second question, you said 3 months you pay back the $10,000. I didn't figure out how with 360,
Sure.
in 3 you pay down the $10,000.
Absolutely. You're borrowing 10, you're creating a note, you're getting 360 every month.
Right.
But remember, we said in the beginning, every month you're still contributing $2,000 from your business.
Oh, okay. So in addition to the 360, you still...
Yeah, because you're paying down the loan. Because remember, we talked about how to build passive income. You can keep putting $2,000 in a savings account for 63 and a half years to get to the 1.5 million, or do some other strategy along with putting $2,000 a month where you're lending out the money and having the other money work for you.
What sort of return on equity do you expect?
Again, every note is different. You're saying when you're lending out, what's the yield?
In your example, what, for example?
The yield here is 12%.
You're loaning money out at 12%?
Correct.
So can you share what's the cost of the operation? Like notes, creating the notes, what do these companies charge, you know?
What's the fee? No, I think what we're driving at is what's the margin between what you're paying for your borrowed money and what you're getting to loan your money.
What's the spread? I think probably the proper question is what's the spread? How much you're borrowing money at and what are you paying? And that's a great question if you are taking a loan for 3 years and you're taking the money and investing it in a higher yield, you're looking at a spread. And we do that all the time. You know, we'll borrow money at 4 or 5%, we're deploying it into a debt fund that's paying us 15%, and we are making a spread. But this is a little bit more elaborate than that because you're really paying your line of credit really fast. So that rate of what you're borrowing money isn't so critical because you're really paying it fast. And the whole point is for you to be able to stack these notes that you have on the investment side.
The faster you pay it off,
Yeah.
then the...
By the way, I mean, we can give you the mathematical model to look at it. It's not super hard to build it. At the end of the day, it's really about understanding the concept and figuring out how to get your money working for you and how to use other people's money to scale a lot faster.
Is 12% a viable rate to get for loaning $10,000 to somebody?
Depending on, again, the asset, the risk. I mean, we have debt investments right now running between 9% and 24%. It's all about risk return. Debt right now is paying double-digit return. Debt is really, it's good to be an investor in debt. It's bad to be borrower of debt right now. I'll tell you that much.
Is there a website where you pick the kind of note that you want to do? Or like, so you have the $10,000, how do people know that you have it to be able to borrow?
Right. So they're actually, there are firms that actually originate notes, and you can come and buy these notes. They have ratings and credit ratings and et cetera. So they're making their money. They're originating for a higher rate. They're taking a spread and then passing it on to you. I mean, that's the standard.
So on this particular example, what is your service for someone who's interested in that? Like, how are you connecting people, or are you just teaching us about the stacking and that's it?
I'm just teaching you about stacking.
Okay. Do you stack?
I just started doing stacking.
You just started.
Yeah. I do spreads. Which means I have capital that I'm bringing in right now in my HELOC at 5.99. I'm deploying it into a debt fund that's paying me at 16% for a first lien position, 60% LTV, and I have that spread. I call it free money. Sign paperwork here, collect $30,000 a year, doing nothing. So I do that. That's what I do in the fund. But this strategy was actually presented to me mathematically. I looked at it, I benchmarked it, I was like, it works. And right now I'm actually doing it for myself. I'm not doing this as a service for anybody else. I'm just trying to expand people thinking for investing outside the classical, oh, I'm gonna save 1.5 million and I need to pull money out at 4%. Just a little wave just to think about things a little bit differently.
Hey, why doesn't Best participate in this? Everybody kicking in a little money and see how it goes.
Absolutely. We can
It
talk
could be
about
called
that.
the Best strategy.
Exactly. Thank you so much, BD.
Thank you all.
That was awesome.